Okay, so we're going to do some problems for chapter 25, the short-term decisions. So let me do example short exercise 4. So dropping our product or segment decisions. So in this case, we want to see if we want to drop any of these departments to see if it will help the bottom line. So obviously this is the one that we would want to look at. The other ones have income, so why would we even take a look? Well, when we want to think about some of these items, think about the joint costs. And the joint costs, if you drop the accessories, your joint costs will most likely not change in that case. So let's take a look at what we have in this case. Let me pull up Excel here. Okay, sorry. All right. So what I'm going to do is I'm going to just take a look at the accessories department. So our expected decrease, if we were to drop it, in revenue would be 97,000. And then we have our expected decrease in variable costs. And that would be, I think, 94,000. Yeah, 94,000. That should tell you right there that it's not a good business decision if you only have 3,000 left after that. Expected decrease in fixed costs. So if we were to drop the accessories department, that would go away. That's 21,000. So let's take a look at what this is. So net, that's going to be a decrease in expenses of 18,000. So 18,000 is going to be able to go to your net income. So that actually is a department that you want to go ahead and drop because it's just not working out for you. Now, this might seem simple in this case, but when we consider some of the other, again, joint costs, we need to do the same sort of formula in order to do this. So I know that it said negative 18,000 here, so that would be obvious. However, some of the other ones that we're going to talk about will not, and you need to go through the same process for that. All right, so with this one, we are going to have to make a product mix decision. So we make two sizes of bins. Now, we have no constraint as far as how much we can sell. We can sell as many of these bins as we can make. But our constraint in this case is going to be the number of hours that we need to, or that we can run the machinery. So that is going to be our constraint in this case. So we can produce 11 large bins every hour, where we can produce 17 regular bins in the same amount of time. So then we have our fixed costs and our sales and variable costs. So let's take a look at what we need to do here. The first thing I want to do is look at my contribution margin for each one of these. So let me do that. So we have regular and large. So regular and large. And our sales price for the regular is $8.90. Our sales price for the large is $10.80. And then our variable cost for the regular is $3.70 and $4.10 for the large. So our contribution margin for the regular is $5.20, and for the large it's $6.70 contribution margin. Okay. So then we need to figure out how we can use that contribution margin with our constraint. And again, our constraint is the machine hours. So I'm going to set this up again. So I have regular and large. And our constraint again is time. So bins per hour. The regular can do 17. The large can do 11. So let's do contribution margin. Again, we have 520 and we have 670. So I'm going to take these and multiply and see what our contribution margin per hour is going to be. We want a higher contribution margin per hour, right? That's the best kind of thing that we can do. So for the regular, oops, times, not plus, this, and this times our contribution margin. So per hour, our regular is 88.40, and per hour, our large is 73.70. So if we were to produce just the regular, our contribution margin per hour, let's find out what the difference is just for fun, would be $14.70 more per hour if we were just to produce the regular. So I would say that you probably want to go ahead and make all of just the regular bins and none of the large, because per hour you have a much higher contribution margin. So the only difference would be if you can only sell a certain amount. Let's say you can only sell, 200 of the small bins, then you want to maximize that one first, and then you can start making the large ones. But we have no constraints with that. All we have to worry about is the machine hours. So we're going to go ahead and make 100% of the regular bins, none of the large bins. That's going to maximize our profit in that case. All right, so let's take a look at the outsourcing. So we're deciding whether we want to bake bread or if we want to go ahead and outsource it, if we want to buy it. So what we want to do is we want to go ahead and figure out what our cost per loaf is. So we have sort of the trifecta here. We have direct materials, direct labor, which is 72 cents. And then we have variable costs, which is 25. And then we have our fixed costs, which is 105. So our total cost, let me bring this up a little bit. So our total cost per loaf is $2.56. So the next thing we need to do is we need to compare what we have to what it's going to cost. But here's the thing. If we are just talking about getting rid of baking bread, we're still going to have some of these fixed costs involved. So we need to go ahead and calculate that as well.